Okay, so let's move the show forward by stepping backwards to yesterday afternoon, past lunchtime, when the Central Bank Governor, Godwin Emefiele, read the communique of the first MPC meeting of 2019, highlighting a number of issues around credit to the private sector and to the government, what we've done so far, what with the inflation outlook, how we do with the non-performing loans in the banking sector, and a few other issues, including the outlook on oil prices for the new year. Let's take a listen to some of the high points of what the governor read out as the decisions of the members, and of course the considerations, or what are called the factors behind those decisions. Let's take a listen.
The resurgence in inflationary pressure in the economy was of concern to the Monetary Policy Committee, as headline inflation year-on-year inched up to 11.44% in December 2018 from 11.2% in November 2018. The increase in headline inflation was driven by food inflation, which rose to 13.36% in December 2018 from 13.3% in November, while core inflation declined marginally to 9.77% in December 2018 from 9.79% in the previous month. The committee, however, observed that the uptick was attributed to seasonal factors which impacted mainly on food. Consequently, all measures of inflation, month on month, showed a decline. Thus, headline food and core inflation declined to 0.74, 0.81, and 0.50% in December 2018 from 0.84, 0.90, and 0.68% respectively in November 2018. The committee observed that the near-term risks to inflation remain the residual impact of flooding on agricultural output, insecurity in parts of the food-producing belts in the country, exchange rate pass-through to inflation due to weakening of oil price, and campaign-related spending towards the 2019 general election. Accordingly, Monetary Policy Committee urged the federal government to sustain its current efforts towards improving security to ease supply chain bottlenecks. Money market interest rates in the review period generally reflected the level of liquidity in the banking system, as the average interbank core rate declined significantly to 7.17% in November 2018 from 14.18% in October 2018. The open buyback OBB rate, which stood at 6.57% in October 2018, increased marginally to 6.76% in November 2018. On December 24th and 31st in 2018, the interbank call and OBB rates, however, closed at 14 and 18.94% respectively. The improvement in the net liquidity position and interest rate reflected the combined effects of the CBN quasi-fiscal operations, OMO auctions, maturing CBN bills, and foreign exchange interventions, as well as statutory allocations to state and local governments. The committee observed the decline in the equities market for the most part of 2018. On a year-on-year basis, the all-share index decreased by 17.81% from 38,243.19 at the end of December 2017 to 31,430.5 at the end of December 2018. The all-share index further decreased by 1.35% to 31,005.17 as of January 2018. Similarly, market capitalization decreased by 13.87% from 13.61 trillion at the end of December 2017 to 11.72 trillion at the end of December 2018. It further declined by 1.37% to 11.56 trillion naira as of January 18, 2019. Committee observed that these developments largely reflected the impact of the progressive monetary policy normalization in some advanced economies and the sustained profit-taking activities of foreign investors arising from perceived political risk in the build-up to the 2019 general elections. The Monetary Policy Committee, however, remained optimistic of the gradual reversal of the current trend in the medium term, given the current stability in the foreign exchange market and the external reserves position, as well as continued improvements in key macroeconomic indicators. The committee noted the relative stability at both the borrowed exchange and the investors and exporters window of the foreign exchange market, supported by the bank's proactive exchange rate management policies. It also observed, with satisfaction, the contribution to stability in the market of the implementation of the bilateral currency swap agreement with China and the inflow of the $2.8 billion Eurobond. Committee also noted the marginal increase in the external reserves from $42.54 billion as at the end of December 2018 to $43.28 billion as at January 21, 2019, noting that these improvements would further strengthen investor confidence in the Nigerian economy. The overall outlook and risks. Forecasts for key macroeconomic variables in 2019 portend a positive outlook for the domestic economy. Output growth is expected to be driven by fiscal stimulus from increase in oil and non-oil receipts to support the federal government's economic recovery and growth plan. The economy is projected to grow by 2% according to IMF, 2.2% by the World Bank, and 2.28% by the Central Bank of Nigeria. Key headwinds to these forecasts, however, are softening oil prices, persistent security challenges arising from insurgency in northeast and herdsmen attack in some parts of the country, and perceived political risks associated with 2019 general elections. The outlook for inflation in the first half of 2019 is mixed, with the expectation of an increase in near term before a gradual decline towards the mid-year. Inflation is expected to rise marginally amidst powerful tailwinds, which include increased spending in preparation for the 2019 general elections and continued disruptions to the food supply chain in the insurgency-prone areas and herdsmen attack on regions of the country. The MPC appraised the possibility of external shocks in 2019 as the outlook for the global economy remains uncertain due to the effects of ongoing trade tensions between the U.S. and its key allies, slower growth in China, unclear direction of a Brexit, negotiations and continuing monetary policy normalization in some advanced economies. The committee was of the view that oil prices may, however, remain relatively stable with the $50 per barrel bracket in view of recent OPEC production cutting actions. Committee's considerations. The committee noted with satisfaction the performance of the economy in 2018, highlighting the achievements in key macroeconomic indicators in the face of global uncertainties and domestic challenges. In particular, it noted the stability in the exchange rate, stable accretion to external reserves, moderation in inflation, and gradual improvement in output growth. The MPC further noted the low but gradual improvement in the real GDP in the last 6 consecutive quarters, commencing from the second quarter of 2017. MPC noted that given global economic conditions and the risk confronting emerging markets and developing economies in recent times, as well as the productive capacity of the economy, the managed float regime management of the central bank has delivered the most optimal results when compared with other emerging markets in recent times. Consequently, capital flows into the domestic economy has continued unabated after an initial lull. The committee considered the risks to the global economy, noting the downward revision in the projected global output in 2019, the adverse impact of the trade wars between the U.S. and its major trading partners, the likelihood of lower crude oil prices, impact on capital flows of continued monetary policy normalization by major advanced economies, distorted signals of Brexit negotiations, as well as pockets of other socio-political tensions and perceived election risks on the domestic front. Committee recommended the government's focused expenditure on investment in infrastructure and urged the federal government to sustain the pace towards addressing the infrastructural deficit in Nigeria. It noted that the immediate impact of this approach on GDP may be slow in coming, but eventually expand the economy's productive base, reduce unemployment, and increase aggregate demand in a more sustainable manner and over a long period of time. The committee acknowledged the strategic role of the private sector in economic growth and remained concerned over the slow growth in credit to the private sector through 2018. Noting the sudden increase at the end of December 2018, the MPC commended the initiative of the Bankers Committee in addressing the phenomenon of low credit to the small and medium-scale enterprises through partnering with the Nigerian Incentive-Based Risk-Sharing System for Agric Lending, the NIRSAL, to establish a national microfinance bank with branches in all states and local governments of the Federation to provide low-interest rate lending to small-scale businesses in Nigeria. A further initiative by the NIRSAL with the CBN to de-risk lending to small-scale enterprises is also being fine-tuned. On external borrowing, committee noted the increase in the debt level, advising for caution, noting that it could fast be approaching the pre-2005 Paris Club exit level. The MPC also noted that although there was an increase in inflation rate at the second consecutive month, based on month-on-month inflation, continued to moderate, indicating that the year-on-year measures will also moderate in the near term. This is supported by the stability in the Naira exchange rate and thus urged the bank to sustain this stability. To this end, it welcomed the narrowing of the exchange rate premium between the BDC segment and the investors and exporters window of the foreign exchange market. Committee also noted with satisfaction the gradual reduction in non-performing loans of our deposit money banks, which has further strengthened their balance sheets. The committee believes that as government pays off contractor debts and other obligations, there will be a sizable reduction in the non-performing loans in the Nigerian banking industry. Committee also noted the attempt by the government to broaden the base of the value-added tax, the VAT, and urged the authorities to expedite action in that respect, arguing that increased tax collection will reduce the pressure on government expenditure and create fiscal buffers to improve macroeconomic management. The observed and recent high foreign capital inflow into the Nigerian economy, despite the perception of election risks, is evidence of the confidence of the international community in the country's macroeconomic management and provides a compelling reason for the committee to await clarity on macroeconomic performance after the general elections in February and March 2019. In the light of the observed risks confronting the economy, including the global and domestic inflationary pressures, which have intensified the risks of currency depreciation, the MPC was of the view that a losing option was very, very remote, weighing the balance of its judgment on price stability conducive to growth. The MPC felt that tightening will result in loss of the gains so far achieved, noting that this may drive the banks to reprice assets, thus increasing the cost of credit as well as elevating credit risks in the economy. It will also worsen the position of non-performing loans of the banks. The committee also felt that tightening would dampen investments and hamper improvements in output growth, given the already fragile growth performance so far achieved. Committee's decision. In the light of the above factors, the MPC decided by a vote of all 11 members to keep the policy parameters unchanged from their current levels. In summary, the MPC voted to 1. Retain the MPR at 14%, retain the asymmetric corridor of plus 200 basis points and minus 500 basis points around the MPR. 3. Retain the CRR at 22.5%, and 4. Retain liquidity ratio at 30%.
The governor of the central bank, Godwin Emefiele, of course, reading those critical points of the conclusion of the two-day meeting of the Monetary Policy Committee, the first in 2019. But of course, as those meetings were being concluded inside the central bank, somewhere else within the city, Nigeria's political capital, Abuja, the Bureau of Public Enterprises and the Nigerian Post Authority were putting pen to paper for $100.78 million US concession of Warri Port Terminal 2 to a new company, a new concessionaire, that's Ocean and Cargo Terminal Services. This is bringing the total number of port facilities privatized since 2005, privatization or concession round to about 25 of them. Let's take a quick listen to the Director General of the BPE. Of course, this is the first port privatization under the Buhari's administration. And after that, we'll take a quick listen to the chairman of the concessionaire Cargo and Ocean and Cargo Terminal Services. Let's take a listen quickly to both of them.
Subsequently, the NCP at its meeting held on the 12th of June 2018 approved the technical bid of Ocean and Cargo Terminal Services Limited and its financial bid in the sum of $100,782,147.53, and they were thus declared as the preferred bidder for Terminal B, Warri Old Port. Distinguished ladies and gentlemen, please permit me to reiterate at this juncture that the objective of the federal government in port concession is to increase efficiency in our ports, improve service delivery, modernize port development, reduce the cost of shipping and clearing of goods at the ports, and relieve the government of the burden of financing the sector. Therefore, the concessionaire is expected to focus on these objectives and align its operations and activities towards the realization of these strategic expectations. Government expects nothing less than a strict adherence to the terms of the concession agreement by the concessionaire.
We're indeed very delighted for yet another opportunity. I'm sure our sister company on Terminal C will delight you on what we're doing. This one too is going to witness the same amount of success, if not more. And because you have trusted us, we won't let you down. Your trust has even transcended even beyond here. In Gambia today, they are looking onto us to expand their port. We've taken over that port. We're going to invest there massively too. And with your trust, we can say the West Coast is just the beginning of our efforts. This one we're doing in Warri, and we're beginning to dream very big there. We want to use that opportunity to decongest Lagos as much as possible and make sure that cargoes meant for the eastern flank of Nigeria actually berth in Warri.
Okay, so that's about the Warri Terminal B concession and, of course, what it looks to achieve, all of that. But let's finish off the program when we come back into the marketplace, and we'll touch on what we call the morning after MPC. Stay tuned, everyone.